Today, I have a question for you. What would you do if one day your neighbor you've known for years starts building a bomb shelter? Would you think, that guy's crazy? Or wonder, what does he know that you don't? Turns out the banks right now are building a bomb shelter. Just this quarter, Canada's big 6 banks have set aside $4.3 billion to cover bad loans. That's almost double of what they set aside the first quarter of last year, and more than 11 times of what they set aside for the first quarter before that. Now, the experts say the big issue has to do with the homeownership. Interest rates rose fast and by a large amount in a way that has never been done before in Canada's history. And the potential for things to go wrong is greater than ever. Mortgage rates are higher than they've been in decades. But that's been true for a while now, right? And rates just dropped. So then what is it that the big banks know that the rest of us don't? Let's see if I can analyze that. But first, you know the drill. Make sure to hit like, share, subscribe, and that bell icon. It gets me motivated to keep you up to date with everything real estate. So far, Canadians have managed rising interest rates pretty well, at least when it comes to staying on top of their mortgage. Only 0.19% of mortgages in Q1 of this year were behind on payments of more than 3 months. That is up slightly from last year. But considering that we've been living through the most aggressive interest rate hiking campaign in Canadian history and record high inflation rates at the same time, we are in decent shape. But here's the thing, even though interest rates have been steadily climbing over the last year and a half, so far the majority of Canadians with mortgages haven't actually seen any change to their monthly payments. Mainly because more than half of them are sitting on a fixed interest rate, but more than 3/4 of all mortgages in Canada are coming up for renewal between now and the end of 2023. Now, back then in 2020, 2021 and the beginning of 2022, we saw historical low rates. The people were taking out loans, then taking out bigger loans. They'd go and buy a house they wouldn't even be able to afford at a 3 and 4%, but they could afford it at 1.25. They called it real estate Christmas because it was the most real estate sold in the history of the country. But now, all these people who got in when the going was good are going to see the payments shoot up. And that depends on when exactly their renewal date falls and how much the Bank of Canada could cushion the fall by lowering interest rates. Now, the Bank of Canada has lowered its benchmark interest rate by 0.25%, the very first rate cut since March of 2020. Symbolically, this is the first rate cut. Now, usually there are more to follow. When we get 2 or 3 more of these cuts, then I think the effect will be visible and noticeable. Now, that's going to take some time. So if you're paying under a 3% interest rate, your monthly payments are going up, and not by a small amount. Now, are we going to see the rates down to the variable levels we saw during the pandemic or before the pandemic? I think the answer is no. Currently, you could be looking at paying like around 50 to 60% more than what you're paying for your mortgage if you fall in the refinance spectrum. But the concern is there are some group of mortgage holders the banks and the government are particularly worried about. It's not the fixed rate holders, it's the variable rate holders with a fixed monthly payment. That is actually most variable holders in Canada. 70% of them have not noticed any radical increase in their payments because their mortgage company sold them the product where the payments did not go up when prime went up. So they've been making the same payment, but they've been increasing their amortization. And if you fall in that category, I have news for you. You're very close to being underwater, stuck in a perpetual state of paying down that ginormous loan. Right now, you are barely paying down any part of the principal. Welcome to the lifelong debt. The time it will take you to pay off this mortgage has nearly doubled. But see, you can't extend your loan forever. At the end of your 5-year term, things snap back into reality, meaning your payments will shoot up. According to a recent report by RBC's economists, some variable rate mortgage holders could see payments jump up as much as 84% by 2026 if interest rates do not decline. And remember, for some people, part of that will be because they paid down so little of the principal. The worst case scenario is that their outstanding loans could be nearly as big as they were at the start, because they've just been paying interest this whole time. They might have been spending the last 5 years thinking they're building equity in their home, to find that that has been eliminated. Most economists do expect rates to keep dropping, but according to the same RBC report, it might not be enough to get them down to a more manageable monthly increased payment. They argue the Bank of Canada would have to lower its prime rate way down to around 2.5% by July 2026, which honestly I don't see happening, because inflation has come down, but it's not there altogether. So this puts real estate and mortgage debt as the top risk for Canada's financial system. If anything is going to destabilize the market, it's the mortgage market. 2 of Canada's most expensive provinces noticed a rise in missed mortgage payments, driven mostly by homeowners under 36 years of age. According to Scotiabank's chief risk officer, the number of customers they consider vulnerable increased by 22% in the last quarter. Most of these people are also in Greater Toronto Area and Vancouver, the most expensive cities to live in. The old rule of thumb is to spend only 1/3 of your income on housing. But today you hear 70 to 75% of income is spent on housing. So in those cases, then if they have to reset at a higher interest rate, it's the house that's going to go down first. We're starting to see why banks are preparing for the worst. It's not just the threat of mortgage default, it's the trickle-down effect these higher payments could have on everything else. Before anyone is going to risk losing their home, they're going to start cutting corners on other things. And data shows that many already have. We might take on more credit card loans, or not pay our car loans or line of credits just to keep up with the mortgage payments. Those are signs of stress in an economy. There are real concerns here. We are seeing some problems with the ability to repay those loans, because Canadians have been so stretched over these past 2 years. Now, how bad this gets all depends on the Bank of Canada. If rates drop substantially over the next few months, we could actually avoid a significant shock. But based on what we've heard from the bank so far, a slow, gradual decline is what's on the books. So if you like this video and have any questions, please don't hesitate to call me. If you still don't know who I am, just go check my rating on Google and read my client reviews. Till then, you take care, and if you found value and liked this video and would like to see more content, click on the boxes on the screen. Once again, my name is Preeti Rao. My contact information is in the description box below. Make sure to hit like, share, subscribe, and that bell icon so you don't miss any future videos. Thank you so much for watching, and don't forget to call me, because I hold the key that opens the door to your dream home.